the bonds that protect against inflation. In this video, I'll share the research that's helping me make investment decisions right now. This is Andrew Stotz of A. Stotz Investment Research. Let's get started. And remember to stay to the end of this video where I will share 3 bond funds to consider. But remember, this is not investment advice. Let's go back to bond basics. When you buy a 10-year, $1,000 government bond, the U.S. government promises to return the $1,000, which is called the principal amount, at the end of 10 years, the maturity date. In addition to returning the principal, the government agrees to pay an annual interest amount based on the coupon rate. For example, a 3% bond would pay you interest of $30 per year, which is 0.3 times 1,000. Now, let's talk credit risk. A government bond is considered risk-free for the people of that country because the government can always print more currency to pay interest or repay the principal. But don't confuse this with foreign exchange risk. If you buy a government bond in another country, it is not risk-free for you because now you're exposed to the risk that the other country's currency could lose value. In fact, you're buying 2 things, the currency and then the bond. Let's talk about interest rate risk. When interest rates rise, the value of a bond will fall. However, this is only a problem if you want to sell the bond to another person before maturity. But if you hold that bond to maturity, you will not be exposed to this risk. Why? Because you're just going to get your initial $1,000 back at the end of the period. But most people are not going to buy a single government bond and hold it to maturity. They're probably going to buy a bond fund or an ETF, and you're going to learn more about that at the end. These instruments are holding and trading a portfolio of bonds. They increase in value. The increase in value will come from both the interest payments and the appreciation in the bond price. Let's look at the relationship between bond index and interest rates. Here you can see the red line is the bond index, and that red line, which is the left-hand scale, I rebased to 100. And you can see that the bond index just went from 100 all the way up to about 600 over this period of time. It's been decades of a bond bull market. Why is a bond bull market happening? Because on the right-hand scale, you'll see that blue line is at 0 right now. Interest rates have fallen from 7% at the right-hand scale. You can see the blue line went from 7% all the way down to 0. Falling interest rates, rising bond prices. And that's the 3-month rate. And next, we can look at the 6 months. We can look at other rates, but the key thing for the 3-month rate is this is the rate that the Fed controls. They try to push it down. Now, what's going to happen in the future? We don't know. The problem that investors face is that if interest rates start to rise in the future, then bond prices will fall. What about my mother? She owns a lot of bonds. That could be damaging. Inflation is the primary driver of bond interest rates because investors demand a high return to compensate for higher expected inflation. If inflation increases, then interest rates usually rise, which will cause the value of bonds to fall. So, why hold bonds when interest rates rise? Well, bonds provide one very powerful benefit for your portfolio. When stocks crash, bonds tend to either rise or not move. So bonds can help investors protect the value of their overall portfolio. Before we go any further, we need a tool. I want to talk about the correlation coefficient to understand this about bonds. It measures the relationship between 2 data sets. A greater than 70% relationship means strong positive. They move in the same direction. A 30 to minus 30% means no relationship. When one goes up, the other one could go down or up. And finally, a negative strong relationship is minus 70 all the way up to 100. That would mean when one goes up, the other one goes down. So what do we find? If we look at bonds and stocks, we find a mildly negative relationship between U.S. stocks and U.S. bonds. Here you can see the correlation I just calculated, and you can see that that is not it's about a 30 to minus 30, so no strong relationship. Actually, you could say it even starts to approach it somewhat of a strong negative, but not yet. So you would say in this case that there's no great relationship, maybe a slight negative. Based on this, if U.S. stocks fall, U.S. bonds would rise or just sit flat. That's very valuable. Imagine if the U.S. stock market started crashing. This would be a valuable asset. So what to do? If we want the diversification benefits of bonds, but we're worried about rising interest rates bringing down their value, well, there's a solution. Let's talk tips. Well, what are these tips? In 1997, the U.S. government created U.S. Treasury inflation-protected bonds to provide an instrument that protects investors against the risk of inflation. The first bond was a 10-year maturity, but now there's many maturities. As of the start of 2020, the U.S. government had issued 44 TIPS bonds, and combined value was about $1.5 trillion, and it keeps growing. Now let's talk about inflation protection. TIPS preserve the purchasing power of your dollars more effectively than depositing your money in a bank. Also, TIPS dramatically reduce the risk of a loss in value if interest rates rise. So how do these TIPS work? With TIPS, the government adjusts the principal amount that will be returned to you at the end of the period. Remember, we said it was 1,000. They're going to adjust that a bit over time. They do this by an adjustment that compensates for the change in inflation as measured by U.S. CPI. So there's actually a floating interest income. TIPS are issued with a fixed coupon rate. But since that rate is multiplied against a principal amount that is changing, then the actual coupon payment you receive will change. So you get the diversification benefit, inflation protection, but you've got to pay by having a slightly lower yield. TIPS generate a lower long-term return compared to traditional U.S. government bonds, but in exchange, you earn enough to keep up with inflation. Short-term TIPS tend to be less volatile than long-term TIPS and have so far offered the best protection against inflation. The typical investor can buy a basket of all TIPS through a TIPS fund or ETF that tracks an index of TIPS bonds. So here we are at the end of the presentation, and I'm going to give you some 3 options. The first one, Vanguard inflation-protected securities fund investor shares. And this is a fund, and this fund has an expense ratio of 0.2 and a minimum investment of $3,000. Again, I'm not giving any recommendation, but I think this is one worth looking and doing some more research on. The second TIPS fund is actually an ETF, and this is the iShares TIPS Bond ETF. And finally, the Schwab US TIPS ETF, and that one looks like this. It's got a lower expense ratio of 0.5. Now, you could look at these different ones in more detail, do some research, but truthfully, every one of them will provide you reasonable protection against inflation, and the expense ratios of all of these are reasonable. So that, ladies and gentlemen, introduces you to the bonds that protect against inflation.